This is PNC Roundtable.
Hello, this is Ric DeVore, Regional President for PNC Bank, and thank you for listening to PNC Roundtable. It's on this show that we tackle some of the region's tough issues with people who make a difference.
Now here's the PNC Roundtable.
Welcome into our PNC Roundtable. Hi, I'm Paul W. Smith, usually with you mornings, Monday through Friday, 5:30 till 9, and here all the time on the Internet, along with my co-host, Regional President Ric DeVore. Ric, nice to see you as always.
Good to see you on this beautiful Christmassy morning, Paul.
It is a Christmassy morning, even if we're far from Christmas and even still far from winter.
Absolutely.
It's just hard to believe, but at least we're not in Buffalo, and our thoughts and prayers for the folks in Buffalo with what they've been putting up with a year's worth of snow in about 3 days. Their average snowfall, 8 feet, and they're going to be there or have been there in 3 or 4 days. Unbelievable. Happy to welcome in our guests, Adam Mackey, who is Managing Director and Senior Portfolio Manager, Head of Municipal Fixed Income at PNC Capital Advisors. Nice to see you, Adam.
Good morning, Paul.
We also have with us Chenault. He is Director of Government Affairs for the fine law firm of Clark Hill. He has made his way from Lansing to join us, and Adam has made his way from Philadelphia to be here. And I'm sure the weather is probably challenging everywhere within the sound of our voice this day.
Yes, sir.
Nice to have you both here and talking about something we've talked about a lot of times, Ric, let's face it, but maybe not from this angle and from the expertise that these two guests bring to us today. We're talking about the Detroit bankruptcy. And if coming through this bankruptcy and the filing and now coming through it, what kind of an impact on the risk premium, as it's called in the business, the interest rate really, that municipal bond investors charge other Michigan general obligation debt issuers? And without it being too inside baseball, Adam, tell us a little bit about how this bankruptcy and coming through it will affect from this day going forward.
Sure. So early on with the petition, with the bankruptcy petition, there certainly was a cost to local government issuers in the state of Michigan and also the state itself. We did see risk premiums go higher by anywhere from 60 to 100 basis points, depending on the issue or the borrower. But over time, as the bankruptcy has worked through the process, we've seen that risk premium decline. So as we look at the market today, at the state level, we're seeing state GO bonds performing very well relative to other AA type state GO bonds. And local GOs, where you would think you'd see the biggest repricing of risk. And I think some of these topics we'll get into a little bit later. But early on, we saw local GO bonds really widen out relative to other local GO bonds across the country. But as time has passed and as more clarity has come around the bankruptcy and what the exit from bankruptcy looks like, we've seen that risk premium decline somewhat. We're still not back to the original valuations that we had going into the bankruptcy. So there is still a premium that is being paid, but it is not as severe as it was early in the summer last year and into the winter of last year.
Well, then, Adam, will Detroit have municipal bond market access to finance the infrastructure, the capital plans, I guess, and the essential services now that the city is emerging from the Chapter 9 process?
We think so. We absolutely think so. We've already seen the city do a lighting deal while they were in bankruptcy, and they were able to place that deal. We know they're going to be doing some exit financing as we get through the bankruptcy here. And we do believe that they will have municipal market access. Again, price will be the interesting point and the point that is debated. But I believe they will have market access. And I know going into the bankruptcy, one of the fears or one of the discussions that was being had was the city will lose its market access. And it's already proven, in fact, that it is not by placing their lighting deal earlier here in this year.
What's the legal opinion on that, Del?
Well, if you look at the Detroit bankruptcy and the judge's confirmation order, he has gone a long way toward attempting to confirm the security of UTGO. And what we're talking about here are the secure bonds, those bonds that are voter approved, that are then funded with property taxes, ad valorem taxes, that are meant to pay those bonds in total, in whole. What the judge did in the bankruptcy, early on in the bankruptcy, was entertain ideas of changing the rules that most of the market has played by, the understood rules, which is voters approve, taxes are then levied and collected, and the bonds are paid. What the judge said was, we will entertain the idea of treating those secure bonds as unsecured debt, so pension liabilities, the office supply claims, and threw all those into the same bin. That kind of muddied the waters of the markets and has thrown things up in the air. What the judge did was said, well, while we may entertain that during the bankruptcy, what he did in the confirmation order then, post-trial, is to say, moving forward, Detroit's bonds will now be considered secure, quote unquote. What has never been answered, the question that has been answered in the bankruptcy, is what does security mean, and what is the severity of that lien? Is it an express lien? Is secure going to be thrown in the air again in a future bankruptcy? Should another city or county in Michigan bring its financial troubles to the point of saying, we're throwing in the towel? The question of how do we treat secure bonds in Michigan, we believe, still is yet to be answered in any clarity.
Well, let's go a little further in that, if we could, Dale. The legislature approved the grand bargain legislation to aid in the settlement. Under the court-affirmed plan of adjustment, the bondholders have been impaired. So will the legislature now step in to consider ways to ensure the state's bond ratings are protected?
The legislature is currently considering a bill, House Bill 5650, which would reassert the security of and the lien provisions of ad valorem taxes to repay UTGO. There was a House bill, or the hearing on the bill last week, Thursday, with just the beginning stages where they took testimony. What came from that hearing was that there was a difference of opinion between what some local leaders are claiming as an issue in terms of recodifying or clarifying UTGO security, and what the administration and Department of Treasury are saying. In the latter case, the Treasury and the governor are saying this is not a necessary move at this time, while many of the market players, bond insurers, and some of the local government leaders are saying, well, wait a minute, we think we do need to have this clarity in order to neutralize any increased interest from the Detroit bankruptcy in the future.
Rick, on your level at PNC, what are you seeing? I hate to use the word fallout because it sounds negative from the get-go, but what reaction have you seen coming through this bankruptcy process in a very positive way, the way we've all looked at it for the city of Detroit? Have you seen that opening the floodgates for business, or is there a little bit of a hold, or what?
Well, and the reason why we wanted to have this topic was that this affects our retail customer base, our corporate, when they're looking at putting munis on their balance sheet, as well as school districts. We've been a very active player at the state level as well as at the school district level, but the school districts are, in effect, state of Michigan risk because there's a Michigan overlay. And I think there's still some question with the school districts about what's this mean for us. Mm-hmm. And that's why I think this bill is pretty important. And don't forget that right now, Detroit's emerged out of bankruptcy at an unbelievably, historically low rate environment. I mean, if you look at the Fed right now, it's 0.07 is the rate. That's probably, our prediction is by the end of 15, that rate might be 1%. Well, that's still pretty low. That's 93 bips different when we don't think those changes are going to be coming in until Q3 and Q4. But if you're going to emerge out of bankruptcy and you're going to issue some new debt, this is probably not a bad time to be doing it, right? Versus, if rates are going to move up eventually, they just have to. They're artificially low. And there's other
We've
banks.
been saying that for a long time, though, haven't we?
We have. Well, and I think here's the key. On the 17th or 16th of this month in December, we have Fed watchers, right? And Adam is one, I'm sure. But you're going to look very carefully at the wording at Yellen's pronouncement. And I think you're going to see the word considerable time that wording is going to be removed from her statement. If it is, the clock starts as to when the rates are going to move, and we, our chief economist, who Stu Hoffman, thinks that'll be in Q3 and 4. I don't know if Adam agrees with that, but he reads the same thing as I do. There's some people that think that real rates by the end of the year might be more like the Fed's rate might be more of 1.25 to 1.5. I think maybe we think we have a little more. We think Yellen might be a little bit more dove-like, and maybe it's more like 1. I don't know, Adam, if you want to.
Well, I don't disagree with that. I think the important thing to overlay here is the conditions of the municipal market. As Rick mentioned, as Detroit is emerging from this process, the market has never been better, in a sense, where the supply and demand dynamics in the municipal market are very firm. So there are more investors looking for bonds, and not as many bonds are being issued. So we call that the market technicals, and we're seeing the market as a very firm time to be issuing debt. If we were emerging from bankruptcy in the fourth quarter of 2010 or the fourth quarter of 2013, I think the premium that Detroit would be paying would look considerably different. So I think over time, over a long time period, we will bear out just what cost to the city, to the local governments in Michigan, and to the state of Michigan this proceeding had. Right now, I think some of that risk premium is being masked by the general market conditions where investors just can't find as many municipal bonds as they need, and it's holding prices high and interest rates low. And then, of course, you overlay what's happening at the national level with zero interest rate policy and interest rate repression and all those things that folks have been talking about for a long time. So timing is very important, and there may not be a better time to be exiting a Chapter 9 proceeding than where we are right now in the municipal market.
But from a longer-term perspective, this lack of clarity on bond security could spell into penalties down the road. This is an extremely liquid market in terms of bond rates. We've got bond yields that are extremely compressed, and when the markets return to what we consider to be traditional rates, back in the 3, 4, 5 percentage point range, that's when you start seeing the separation. And there are some that hold that without that clarification of security, there will be a penalty for Detroit and Michigan borrowers as a whole moving forward.
Del Chenault, Director of Government Affairs of Clark Hill. He's in the Lansing office, and also with us, Adam Mackey, Adam Mackey, Managing Director and Senior Portfolio Manager, Head of Municipal Fixed Income for PNC Capital Advisors from their Philadelphia office. And then there's Rick and I from right here in Detroit.
Right.
And we're talking about the things that will affect all of us coming out of this Chapter 9 bankruptcy as we have. I guess one of the questions, Adam, an opinion from you would be, were bondholders treated fairly in the accepted plan of adjustment relative to other creditors? And if I didn't say relative to other creditors, the answer would be a lot faster.
Well, that is an interesting question. My answer to that generally is yes, looking at the results of recovery for all of the creditors. I think the most interesting precedent that came from this bankruptcy for us, not just in Michigan, not just in local governments in Michigan, but broader based across the country, is this whole idea of if you have a secured lien or an unsecured lien for general obligation debt, and if there is distress, what does your recovery look like? Historically, we had assumed 100% recovery. We assumed that general obligation debt backed by ad valorem property tax was secured. And in this bankruptcy, we learned that it is not. So all we have now is a promise to pay, but we don't have a secured obligation. That could change the pricing going forward for all local GOs. But when I look at the legal priority of the claims, I see bondholders being treated fairly relative to other bondholders. So if you were a pension bondholder relative to an unlimited tax GO bondholder relative to a limited tax GO bondholder, I think you got treated fairly relative to other creditors on the bond side. One area where I would point out where unsecured bondholders or unsecured creditors, the pensioners, Another thing we learned from this bankruptcy is that creditors and pensioners, which we thought we were on parity with, we are in fact not on parity with. Creditors had a higher recovery. Pensioners had a higher recovery than bondholders, even though the pensioners were deemed to be unsecured and the unlimited tax GO bondholders were deemed to be unsecured. Recovery was higher on the pension side. So that is another interesting fact that came from this bankruptcy, is in fact that bondholders are really subordinate to pensioners in a proceeding.
I don't know how much you guys followed it, being from Lansing, maybe more so than Philadelphia, but probably because of your interests, everybody in this room followed it. The auto industry bankruptcies for General Motors and Chrysler. There was new ground broken, and some people say illegal ground broken, in terms of the way the president stepped in and made decisions on who gets their money and who doesn't. And people are saying, wait a minute, we're secured and we're not getting our money, and these are unsecured and they are getting their money. So it seems as if every time we go through something like this, there's new ground, and not everybody's always happy with it.
I think the biggest difference is with the Detroit bankruptcy as compared to the automaker bankruptcies was that you did have statutory liens for the UTGO bondholders that were collected with property taxes. There was a distinct revenue stream to pay that. And for the pensioners, they thought they had a constitutional lien or constitutional protection, which was thrown out by Judge Rhodes.
And then the auto folks were not issuing secured debt like that. A lot of their debt was unsecured.
Correct.
So a little bit of apples and oranges there, and and I will say, Adam follows. I was amazed at his knowledge of this bankruptcy, but maybe I shouldn't have been, because we do have a portfolio of $7 billion in municipal debt. So the precedent setting is really important to him. And then Dell is our liaison in Lansing for our bank, and I get weekly updates from him in writing, and of course he has other clients as well, but that's what we count on him. And that's
he doesn't. You're the
we're the one and only.
Tell him, Dell, you're the only client
today,
right now, at this moment,
in this room.
But for retail folks, or if just the regular person, it's almost like you have a mortgage on your house and you have a note that's your promise to pay, and you signed a mortgage, and then all of a sudden that mortgage slides down and becomes a second lien without nothing happening. It would be a way that I would. That's the way I've explained it to some of my relatives. I said, all of a sudden you're in a second chair and you don't remember. Nothing happened.
Right.
And you still have that note, your promise to pay. So it has been, and also in the corporate bankruptcies, except for the autos, because that was such a huge economic effect on the country and certainly this region. But if you went through a regular bankruptcy for a corporation, you wouldn't have this political side of this at all.
Well, and it is political. and I'll ask you, Dell, how have other states' political leaders reacted to shore up bond ratings in similar Chapter 9 municipal bankruptcies, even though there wasn't one anywhere close to this size?
Right.
Interestingly, when you look at the other states in the country, 30 states have either some sort of statutory protection of these types of bonds, secure bonds, or constitutional protection. In some cases, I think in 4 or 5 states, they have both. When you go back and you look at what Rhode Island did when Crystal Falls, Rhode Island, fell into bankruptcy, or was about to fall into bankruptcy, their governor and legislature acted immediately prior to the city filing their Chapter 9 to create a security statute that included a state aid intercept provision. And that state aid intercept provision said, if the time comes that you cannot pay your UTGO bonds, we are going to step in. We're going to intercept your state aid. We're going to pay the bondholders, and we're going to ensure that that bond stays 100% intact, because I think they realized that if those bonds were impaired, it would set a national precedent, and of course a bad precedent for the state of Rhode Island and its local governments.
But did the Detroit filing have ramifications for the broader municipal fixed income markets from a risk or liquidity perspective, Adam?
Well, early on it did. Certainly when the bankruptcy protection was filed, it certainly did have ramifications. There was a lot of headline risk. It was a different market environment at that time. As you recall, the Federal Reserve was beginning their taper program, and a lot of folks were selling bonds, and we saw municipal bonds suffer. We saw Michigan bonds suffer, local government bonds in Michigan suffer. But the broader ramifications really will be felt as we exit the bankruptcy. You know, at this point, I would tell you no, there have not been significant ramifications from a liquidity perspective and/or from a cost of borrowing perspective. But going forward, these issues about where do we stand as an investor, as a bondholder, what lien do we have, what legal lien do we have, and how do we price that risk? It is okay to be subordinate. I don't think any bondholder would tell you it's not okay to be subordinate. It's okay to be subordinate if you know going in that you are subordinate. So I think going forward, we are going to reprice these risks based on the outcomes here in the bankruptcy. Things like pension bonds. You know, I suspect it will be a long time before you see local governments issuing pension bonds into the municipal bond market. Why would the muni market finance in any way, shape, or form a transfer from a bondholder to a pension fund going forward?
But a couple of things. Interestingly, I think the legislature is starting to consider those ramifications. And there's another bill that will lower the required bond rating for a city to issue OPEB bonds from AA now to single A. But the requirement is that if you are a single A rated entity and you want to issue those OPEB bonds, those bonds must be wrapped by insurance, bond insurance. So I think the legislature is beginning to understand that there could be some long-term issues that could create liabilities for these local governments. So we need to get out ahead of that.
So are we saying then, Del, that Detroit's bankruptcy and bond impairment is producing a contagion effect for Michigan's local governments, cities, schools, utilities? What are you're up in Lansing. What have the opinions been from the local governments expressed in this regard? And do they fear increased borrowing costs in the future?
I think you've seen early on, as Adam indicated, some impacts. We saw local governments who pulled issues from the market, came back, and seemingly received very good treatment from the markets and had interest rates that were competitive. But in terms of the voices of local government leaders, Bob Dado, our good friend from Oakland County, who's part of Brooks Patterson's team, has been very vocal about the impacts of Detroit, and very vocal about ensuring that governments who've done a good job with their finances, AAA rated communities like Oakland County, are protected moving forward. While there haven't been an incredible amount of increased interest rates, it's not to say that that won't come in the future. When you look at Michigan, we've long paid a quote-unquote Michigan penalty for our bonds. We've always traded above, for a long time, decades, above the U.S. index. Currently, Michigan trades about 93 basis points above, which is about 1 percentage point. The cost of that 1 percentage point is about $525 million over a 5-year period of time based on the $7 billion in average bonds that we issue today. So, yes.
All right. And regarding Governor Snyder and the Michigan Department of Treasury, is the Detroit bankruptcy a precedent or an exception for dealing with other financially troubled local governments in our state? This comes to mind in a conversation I had most recently in an interview with Wayne County Executive-elect Warren Evans, when I asked if Wayne County is in a position of having to file for bankruptcy. And he said, I think things are getting better every day, but I'll never say never. We haven't gotten into the heart of all the troubles in Wayne County, and if we find out that we have to, then that would be one thing that we'd have to take a serious look at. So never say never. Could be another bankruptcy. So the question is then, do Governor Snyder and the Michigan Department of Treasury plan to move to reassure bond investors in the financial markets regarding the security of these bonds in Michigan moving forward? And is this an exception or the precedent now for these other communities that might be in trouble? And I ask that of both you and Adam, Del.
Well, I'll take the political part of it first, but when you look at the statements from the governor, he has made many trips to Wall Street to reinsure the markets since he's been governor that Michigan is a good place to invest and do business. But when you look at the Detroit bankruptcy and when it came to the issue of secure versus unsecure on voter-approved bonds, the governor endorsed the first plan from Kevin Orr, which treated them as those secure bonds as unsecure. At this point, when the legislature has begun to investigate potential contagion and the security and reconfirming security of UTGO and statute, they've said, the status quo is fine. We don't think we need to make that move. And I think the reason for that is, without putting words in the governor's mouth, is I think they want to have all of their options on the table, up to and including impairing bondholders in the future.
I would argue that going forward, this will be the playbook for bankruptcy in Chapter 9 at a minimum in this state. What happened in this bankruptcy, there's so many complexities here, but talking about the water and sewer bondholders, how they got drawn into the estate, were going into it they thought they never would. I think that the bankruptcy here was really able to bring a lot of creditors to the table who did not think they would be at the table and get concessions from almost all of them. If I am a struggling entity who needs to use Chapter 9, which should be a last resort, but if I have to use that, I will try all of the things that happened here. I will try that in my local
I think it's going to be the playbook around the country, frankly.
I think so. I agree with that. Now, short term, I think that might appear to be the right thing to do. I think long term, there could be longer term ramifications, and these, lien priorities and those types of things. But remember what local governments borrow money for, right? We're talking about schools and gymnasiums and capital plans for those local constituents. There will be a price to pay if you cannot finance, right? So the cost of financing could potentially go up long term, given these short-term decisions to extract $250 million from the water and sewer bondholders, to extract $100 million from bondholders that thought they had a secured lien, and now it's not secured. So it's $100 million today and $250 million here. But over the next 100 years of Detroit, when none of us are here, will that cost be recouped by the financing community? I would argue to you there's a big difference between financing and funding, right? It's our job to finance. It's the local government's job to fund. And I would argue to you that over the long term, some of the things that happen in this bankruptcy will not be prudent long term. Short term, there's savings to be garnered from doing these things, but long term, that will be recouped by the financing markets. You are going to be an ongoing concern for much longer than 10 years or 20 years or 30 years. So that's how we look at it as investors. And just to be clear, again, these issues are really groundbreaking issues for municipal bond investors. Whether you're a retail investor, whether you're an institutional investor, a mutual fund, these types of issues around pensioners versus bondholders, around secured lien versus an unsecured lien. We make many loans or own many bonds where we are unsecured. That is not the point. The point is, at the point of that transaction, legally, where do we stand? If we don't have that legal contract to fall back on, the market becomes, of course, less orderly, more fragmented, and ultimately it winds up hurting the constituents of that particular financing. It all comes back to Wayne County taxpayers or Detroit taxpayers at some point in the future.
Dale, how does Michigan's bond rate compare now, our rates, compare to other neighboring states, and for that matter, all of the United States? Obviously, Detroit's bankruptcy is a factor in those rates. Should this be a concern to we Michigan taxpayers?
Yeah, I think so. As I stated earlier, Michigan does trade above, the U.S. index. When you look at AA minus bonds in Michigan, they're trading 2 or 3 notches below what a similarly rated entity is in other states, including our neighboring states. And part of that reason, we believe, is while some of it is generational in nature and traditional, the policies that were adopted in terms of the Detroit bankruptcy on the security of UTGO have set a precedent. And we think that precedent will exacerbate the problem, will aggravate this Michigan penalty and increase costs potentially in the future, unless we get some clarity and recodification around our security in our statutes.
But by the way, can I just add, going back to this
Sure.
whole pensioner bondholder, there's other bankruptcies going on right now as well away from Michigan, and I know that's our concern today. But Stockton, California, cleaning itself up at the same time. Judge in that case ruled that pensioners can be impaired as well as Judge Rhodes did here in Michigan, except Stockton chose not to impair their pensioners at all. So in different jurisdictions, different things will certainly happen.
But what is precedent in Detroit compared to Stockton and these other bankruptcies is that Detroit did impair its secure bondholders. That was a national precedent.
Sure.
And in spite of all the other bankruptcies that have come before and likely that will come after, it is the first time that has happened. And
is that the main precedent, or if not, what are some of the main precedents that, as we wrap this up, that the municipal bond investors can garner from the Detroit Chapter 9 experience? That's a question to both of you.
Sure. I'll start. That is certainly primary in our mind as a municipal bond investor. It's interesting with those bonds and the unlimited tax GO bonds, the holders of those bonds or the creditors on those bonds, I wonder if it wouldn't have been different if the $400 million in unlimited tax GO bonds were owned by purely institutional investors and the creditors were institutional asset management firms, or if they were bond insurers. In this case, all of the $400 million, the creditor was a bond insurer. A lot is at stake for a bond insurer. There's a tremendous incentive for them to settle. Whereas you see in Stockton, California, where there was no GO debt to impair, but there was lease debt to impair, the loan holder of that lease debt fought to the very end and did not settle. Now, the outcome was not favorable for them. But if they were a GO bondholder, if this was owned by institutional investors, I'm not sure that we would have started off with that debt being unsecured. Looking at what the fight would have looked like given who held the securities. But certainly for us as investors, that is a critical point for us is what lien do we have on voter-approved general obligation debt going forward. I would argue to you that we don't need another bankruptcy to figure that out. We don't need another default to figure that out. We should discount that risk right now. And I think across the country, we should see local GO bonds cost of borrowing go slightly higher, simply given what happened in this case, the fact that par was not received for that lien. Number two, on the pension side, I think we got affirmation. As a bondholder or an investor, we got affirmation that we are in fact legally on parity with them. But in reality, the local politics and practicality of the case and what's happening in that local jurisdiction are really going to trump bondholders. So I would go into a transaction now, assuming if I were going to be loaning my money to a local government that had pension expense and pension exposure, that we would be subordinate to those pensioners. Whether legally it says that or not, we would essentially default to that when entering into that transaction. So those are really the two main issues for us that came from this case. And I would hope that the market itself can instill some discipline around issuers using this option, this Chapter 9 option. My concern is that our market, the municipal market, is a little bit more fragmented than others in general, just by who owns municipal bonds, right? So 50 to 60% of all these securities are owned by retail investors. So I don't know that we will instill the discipline that should come from this case going forward.
I think from a political perspective, there are two precedents that were set in this case that are that have some people troubled. Certainly, local governments are troubled. Our public borrowers are troubled in Michigan by the fact that what we thought was a secure or ad valorem tax security in statute was found to be really not so secure, number one. And number two, the constitutional protection for pensioners and pension benefits was found not to be so secure as well. So for pensioners and local government borrowers, there certainly is some storm clouds on the horizon that I think have many people worried.
Ric, final word.
Well, I think, for me, there's three things. And, if you take I'm going to take the tack of John Q. Public. A lot of people say, well, why is this important to me? Besides the obvious, if you're, a pensioner, but then the obvious, you live here. But the third part is, as Adam was alluding to, and Adam has schooled me on, this debt is held a lot more by the retail market than, say, maybe the corporates. A lot of moms and pops all over the country have some of this debt because they enjoy the tax-free nature of it. And so I think this is one where some people think it doesn't affect me, and then they look at their portfolio and say, hey, this does affect me. I like those municipal bonds. So I really think that this is one that I think people have to notice for those three reasons.
All right. Makes good sense. We thank our guests for being here. Del Chenault, the Director of Government Affairs. He's based in Lansing for Clark Hill. Nice to have you here, Del.
Pleasure.
And from PNC Capital Advisors, Adam Mackey, Managing Director, Municipal Fixed Income, a member of the PNC Financial Services Group. Thanks for coming in from Philadelphia.
Thank you, Paul.
We hope to see all of you again soon. And, of course, Ric DeVore, the president of PNC, will be with us again on our next PNC Roundtable. And I'll be speaking to you in the mornings on News Talk 760 WJR. Regards, Paul W. Smith.